Good morning and good evening, depending on where you are in the world, and thank you for joining us for our webinar today. My name is Aleem Ramtullah. I'm the co-head of private equity at Developing World Markets. On behalf of the entire team at DWM, spread across 11 locations globally, we'd like to welcome you all and thank you for attending today's webinar. It's our second, as many of you know, on this topic of resiliency, with a focus this time on our MSME clients, our micro and small medium-sized enterprise clients of our portfolio of financial institutions globally. We're humbled by the incredibly positive response for today's webinar, with nearly 150 people registering for the event. Before getting too far into it, we'd like to express our sincere gratitude to our equity fund LPs, Nuveen, KFW, OEB, AFO Parnas, among others that have joined us today for their continued support and encouragement of DWM's impact initiatives. We'd also like to thank our portfolio companies for their participation in the survey. It was a tremendous effort, and we look forward to working with each of you in the coming weeks to unpack the data further and find actionable strategies to work with each of your clients. Thanks finally to the team at BFA Global, who we have represented on the call today, for their incredible work and their partnership throughout this process to help parse this data and tease out the critical insights. We'll hear from them momentarily as well. For those who are unfamiliar with DWM, we are a global impact asset manager. We were established in 1994. And over the last 2 decades, we've deployed over $2 billion in private debt and private equity assets across 50 emerging and frontier markets. And that's into over 200 impact institutions, primarily financial institutions. Today, we manage close to 700 million in assets across 6 active funds, and we invest across sectors, and again, with a deep expertise in inclusive finance. When we came together in May for our first webinar, there was a lot of uncertainty on the way the pandemic and the resultant lockdowns would impact our institutions. We highlighted how the FIs in the portfolio were dealing with liquidity constraints. We highlighted how the anticipated portfolio quality issues may result in insolvency issues for some of our institutions. While plenty of uncertainties still remain at the institutional level, I think some issues are becoming quite apparent for our micro and small medium-sized enterprise clients of the portfolio companies themselves. We understand that the pandemic has obviously widened the already worrisome levels income, racial, ethnic, and gender inequality globally. As some of you must be aware, this past weekend was October 17th was International Day for Eradication of Poverty. This was established in 1992 by the UN General Assembly, and we've been celebrating it for the last 20 plus years. And this is the first time in over 20 years that we will not be able to demonstrate progress year on year. To be fair, that rate of progress had already started slowing before the pandemic because of climate change and conflict. But for the first time in 20 years, global extreme poverty is expected to rise as a result of these compounding forces of COVID, conflict, and climate change. Prior to this year, 750 million people were already living in extreme poverty. Half of humanity was living on less than $5.50 a day. And according to the now often cited World Bank estimates, the pandemic is likely to add between 88 and 115 million additional people. Climate change is likely to contribute up to another 130 million, and by 2030, 66% of the global poor are likely to be in conflict-affected areas. These forces put together are erasing almost a generation of gains we've made. It also has, however, highlighted the inequities in our society and made them apparent for the broader public who don't live and breathe this work. The way that, and they've not devoted their careers to this effort the way many on the call have. Our hope is that this creates a sense of common purpose and shared destiny. We at DWM are hopeful that we are at the precipice of a transformative moment if we are serious about creating a just society. This more just society will necessarily include support for what is often the engine of innovation and entrepreneurism and job creation in most of our markets in which we operate, micro and small medium-sized enterprises. various estimates suggest that SMEs account for anywhere between half and 2/3 of the net new private sector jobs. How can we possibly build a more inclusive economy when 70% of SMEs lack access to basic credit? It's simple, right? You can't access capital, you can't invest in and grow your business, you can't buy a home, and you can't build wealth. And it's that wealth, not just income, that is the means to security globally. Inequality is deep-rooted, but it's not inevitable. It'll take strong partners and sound evidence-based decision-making to help our clients build back better. And as impact investors, we must now usher the move from investments into businesses that simply exercise greater shared responsibility to those that, in John Elkington's words, build the resilience and aspire to regenerate our communities and small businesses in order to drive a more equitable and inclusive society. And this is why we're excited to have partnered with BFA Global to assist our portfolio of financial institutions with their next steps in understanding the impact of the pandemic on the health and viability of their clients. So with that, I'll stop talking and I'll hand over to David Del Ser, Director at BFA Global and Head of the FinSalud program in Mexico, to tell us a little bit more about BFA and the work they've done.
Thanks so much, Alim. Those were pretty enlightened words. I hope I can follow up to. but just seriously, just a couple of minutes of an introduction to BFA. I don't want to stand between the audience and the insights, which is really why you're here. Where BFA Global is a innovation firm that is focused on finding and supporting the solutions to all problems like poverty, right? By leveraging the power of technology, the power of finance and data to really affect change. We're also increasingly focused on new problems like climate change that were not maybe so much in the radar a few years ago. We basically apply research, advisory services, data analytics, product innovation, and other skills while working with the world's top innovators, development organizations, policymakers, financial institutions, and the like, to help build those solutions that can contribute to more sustainable and more inclusive economies, right? About the beginning of the COVID crisis, as it was exploding, we ran a number of surveys in about 10 countries globally, quick surveys to just get a sense of what was happening, because no one knew what was happening as close as next door, right? And we presented those results through webinars just like this one. And Alim attended one of them, and we started talking afterwards to the question of, can we apply a similar technique, but not so much to a country, but rather to a portfolio of companies and their portfolio of clients. So that conversation that started in a webinar ended up in a project that is this one project that we're talking about here now. So I just want to send a signal of hope that these webinars sometimes lead to action, which is great to know. And with that, I'll just pass it back to Ashwin so he can tell us about the results of the project. Thank you very much for making the webinar today.
Great. David, thank you very much. And thanks, Alim, for the introductory remarks. Hi, everyone. My name is Ashwin Mableshwar. I'm a director here at DWM, and I am a portfolio manager on the firm's private equity team. I'd like to start off by just providing a snapshot of what we've been doing at DWM. Now, we've been working hard during the course of this pandemic. We've been working along with all of our companies globally. So we have 88 portfolio companies right now across the debt and equity practices in about 33 countries. One of the things that we've seen is the needs and the focus areas of these companies have evolved significantly over the course of the past 6 months. So when we started off, the focus really was on liquidity and crisis management, which was the focus of our original webinar, which we held in May. Now, what's happening is companies are looking ahead and looking at relending and how is it that they're going to move forward. Looking at where we're at right now, given COVID, we've got anywhere from 10 to 50% of company portfolios that have been restructured as a consequence of government-mandated restructuring. If we look at one key metric of what is the risk appetite of companies right now, I think this is one thing that stands out is what's up here, is the level of liquidity that the companies are holding. Now, the liquidity that we're looking at here is basically liquid assets divided by the total assets of the company. Now, we typically have our covenants at, on the debt side, have covenants at 5%, standard levels of 5 to 8%. So if you look at where it was to where it's at right now, we have a median level of 18% being held in liquid assets, which is a 45% increase from March when we first started monitoring for COVID. In particular, what we've seen is that Asia and Latin America, in March, it was already, the companies there were already holding higher levels of liquid assets. But over the last 6 months, what we've seen is we've seen a significant jump in the liquid assets being held at two other regions as well, which is Asia, which is Africa and the Middle East, and also Eastern Europe and the Caucasus. So these areas have seen a 60% jump in the overall level of liquid assets. Now, what is this symptomatic of? So the issue is that there is inertia right now because there's a lot of uncertainty as to companies being able to ramp up their lending. They're uncertain as to where to relent. And that was essentially the genesis of the survey that we undertook. So essentially, we partnered along with BFA, and we were looking at finding out the answers to three kind of key questions, which our management teams had identified. So firstly, what is the economic impact on the end clients? What's the revenue shock and what is the recovery forecast? Second is, what should be the new products that they're introducing into the markets? And finally, what is the level of digital adoption that clients are actually willing to take on? So to this end, what we did was, along with our partners at BFA Global, we conducted 3,500 surveys across eight of our private equity portfolio companies in 6 countries. Now, these were companies that are located in India, in China, in Armenia, Georgia, Colombia, and Panama. And out of these, 60% of the end clients that were surveyed were microenterprises, 40% were small businesses. So now, going over the next few slides, what I'm going to do is I'm just going to provide a quick summary of some of the survey results over these 3 key areas before handing it over to our colleagues at BFA to provide some additional insights that came out from machine learning. So firstly, looking at the overall level of revenue loss that we saw across the portfolio. A couple of key things that we were looking at were over here, and why management identified this as a key area is this was a key insight in informing our management teams in deciding on the levels of provisioning. How much should they be providing for delinquent loans? What is going to be the recovery expectations? Now, what we saw that in terms of the end clients, across microenterprises and across SMEs, over half of the clients, over 50% of clients actually reported that their revenues were down at or above 50%. So now these were material declines across the board. And much like in developed markets, if you look at some of the sectors that were hit particularly hard, you had retail, food services, manufacturing. These saw immediate declines. But ultimately, one of the things that didn't come across was it wasn't the sector itself that drove the decline. It wasn't macroeconomic considerations. We saw something that was kind of across the board. Now, what was particularly interesting here, and this is where the machine learning insights that BFA has employed are particularly interesting, is that there have been some interesting trends that have emerged of the relationship of loan size, the level of digital adoption, the presence of emergency funds. Now, these actually turned out to be key predictors as to A, what was the revenue loss that our end clients experienced, and B, what was the revenue recovery. So these are some of the things that we'll be going over a little bit later on. So the second piece that we were looking at was in terms of relending. So where should our portfolio companies be relending? What product should they be focusing on? Now, if you look at SMEs compared with equipment, tools, digital literacy, qualified workers, when we surveyed our SME clients, compared with all of these, there was an overwhelming majority that indicated that working capital was their top need of the hour. So it ranged all the way up to 85% of the respondents in one of our portfolio companies that indicated that working capital was crucial. For microfinance customers, on the other hand, so essentially, if you look at the split, within microfinance, there wasn't a key preference. The working capital did not come out as a key preference in terms of product preference. But what was particularly interesting, as we'll see from some of the machine learning slides later on, was there was an interesting link between product preferences of our end clients and what was their actual revenue recovery expectations. So there was a material link between those two, which for our management teams is very important while assessing the associated credit risk when they are relending. And then the third piece that we were looking at was the end clients' willingness for digital adoption. Now, one trend that's completely clear overall is that our portfolio companies have been increasingly digitizing their business models. Now, the end client's willingness for digital adoption was particularly interesting, given a couple of trends, right? So in emerging markets, we've seen increased rates of mobile penetration across the board. And we've also seen that with physical lockdowns due to COVID, most of the collections were actually digital. So wherever we had physical collections, which is a significant part of the portfolio, physical collections were not high. So the willingness of clients to transact digitally was a crucial piece. And what we saw was that over half of microfinance clients surveyed indicated that they are willing to borrow via digital means, up to 85% in one case. Not surprisingly, the younger, that is clients aged less than 35, are more likely to consider a digital loan than our older clients. And as we'll see that from the next section, the willingness to adopt digital products has interesting links to existing level of digital use already within our client base. Now, I'd like to for the next section, I'd like to hand it over to Ben Mazzotta from BFA Global. What Ben will be doing is taking us through some of the machine learning insights that I've referenced here. Prior to doing that, I'd like to launch a few poll questions. So these, we'd like to request our audience members, you should have seen it pop up right now. So essentially, what you'll see is a total of 4 poll questions here. We will leave the poll questions open for a few minutes, actually, through Ben presenting his first few slides. And then after that, we'll close them out, and then we will discuss the results of the poll findings and see how they did, how the results here compare to what we saw from machine learning insights. Now, during this time, I'd also request that everyone use the Q&A box to ask any questions of the panelists. We're actively moderating this, and we will answer all the questions towards the end of the presentation. So without further ado, over to Ben for the machine learning insights.
Well, on behalf of BFA Global, I'd like to express our gratitude for the opportunity to work on this project. From a research perspective, this has just been exciting for us to understand how the crisis has unfolded and to really see it through the eyes of a general partner in the portfolio companies and to have a chance to speak with their clients at scale. BFA Global, much of our research revolves around this idea of financial health, meaning how does one prepare a household? How does one prepare a business for a crisis? How does one use financial services to prepare for the future? And in gathering this data, we've been able to look at exactly those things, the meaning of the crisis for the customers of the portfolio companies, and of course, the role that digital technology can play in the recovery. Next slide, please. Well, if we look at the respondents in the survey, we've divided them up by size. So some of the respondents to the survey are microenterprises. Some are small and medium enterprises with the exact thresholds determined by the reporting portfolio companies. But we know that the crisis has been important to businesses and that they're going to need a diverse set of tools in order to get revenue back on track. In this slide, we're looking at the fraction of the companies in each category who have reported that they forecast additional revenue will be coming online within 6 months. What kinds of revenue did we ask them about? Many different kinds: bank funding, capital infusions. We asked them about government supports, charitable funding. But crucially here, we're looking at additional business lines. So this is a pivot to a new business model as reported both by microenterprises and small businesses. The microenterprises are in green and the small enterprises are in yellow. Across the board, roughly a third of companies state that the new revenue that will be coming online within 6 months is a new business line. But it's not the same everywhere. We can see from one industry to another that the rates at which new business lines will come on stream is it's different from industry to industry. In SMEs, the rates of new business lines are higher in the industries of manufacturing and agriculture. Whereas for microenterprises, the food service sector was the most common type of enterprise to report a new business line. So again, this is within industry, within category, the percentage of businesses who state new revenue will be coming online soon. Next slide, please. There's also a gender gap, and the gender gap isn't necessarily around the access to finance. It isn't necessarily around the types of businesses that are owned by men versus women across the portfolio. And certainly the shares, as we saw on the earlier slides, the shares of businesses owned by customers who are female in different markets is different, with different portfolio companies is different, and in different industries is different. So there are pervasive differences between male-owned and female-owned businesses throughout our data set. But one thing that we've noted is that SMEs in the sample are much more likely, 76% to be male-owned, than our microenterprises, of which only 56% are male-owned. This isn't microenterprises across the world. This is only our sample, the respondents to our survey with these portfolio companies. And yet the rates of e-commerce adoption are strikingly different by gender. This is not a controlled social science experiment. This is not a statement about how women run their lives or who's better at digital, but instead what we observe, if we simply look at the population, is that female-owned SMEs are much more likely to use e-commerce across the board, and particularly so when the outlook on revenue is highest. So if we look at 3 different buckets of businesses based on their forecast revenue recovery, the lowest is the pair of bars at the bottom, the middle forecast revenue recovery is in the middle, and the highest is at the top. We see that of those who are female in the highest revenue recovery forecast, 35% of those are using e-commerce today, versus 20% of female-owned businesses with the poorest revenue forecasts. And across the board, all these levels are higher among female-owned businesses than among male-owned businesses, which might be down to the markets that they operate in. It might be down to demand. It might be down to industry. But nonetheless, the fact of the matter is that there is this massive gender gap. Next slide, please. Female-headed rural microenterprises have the highest rate of holding tangible assets. So with regard to financial health, we look at the spectrum of assets that can be held, meaning cash, meaning site deposits, meaning access to credit, meaning access to insurance, many different ways that a microenterprise or a small business owner might be able to make it through a crisis. And among the tools that is very common in the rural sector is to hold something tangible, meaning gold or livestock or real estate as a hedge against calamity. And these assets can be sold to generate cash in a crisis. Rural clients across the board are less likely to hold a bank account than urban. This is nothing new, 40% in our sample versus 53%. Rural microenterprises have much higher rates of holding tangible assets as a hedge against calamity, meaning those assets I just mentioned, gold, livestock, and real estate. And the trend is more pronounced among women, and particularly among those without bank accounts. So if we look at the colors here, we're dividing up urban versus peri-urban and rural. And this is the fraction of respondents with tangible assets to sell in case of an emergency. As you can see, among the female respondents, the rates of holding these tangible assets are actually higher among those with no bank account, when we might expect the opposite, because we might expect that having income or having wealth to put into the bank account would also be something that determines the holding of those assets in the first place. So here we see females in the rural sector, even without a bank account, are holding assets at a higher rate than those with bank accounts. And across the board, the female rural is higher than the male, and the rural is higher than the urban. Notably, rural populations with access to insurance show the opposite trend, lower holdings of tangible assets, but that isn't actually on this slide. That's a separate finding. Next slide, please.
And so thanks for that, Ben. We're just going to take a quick pause here to review the results of the survey before we move into additional specific data insights. So we're just going to publish the results real quick. Okay, excellent. I'm going to hand it over to my colleague Sadaf to review the poll results. Sadaf, over to you.
Thank you, Ashwin. Hi everyone. This is Sadaf. I'm a senior associate on the DWM private equity team. Cover the Asia portfolio, and I'll just quickly walk you through the poll results that we have. For question number 1, which asked what is the best predictor of the severity of revenue decline among MSMEs, most people taking the survey answered option 1, which is the availability of emergency funds or emergency pools of capital. For number 2, we see which asked what is the best predictor of expected revenue recovery among MSMEs. The options were equally split, with the use of digital payments slightly edging out the availability of short-term investment assets. For the third question, which asked how many of the microenterprise clients or what percentage of the microenterprise clients who did not have access to any digital channels or did not have any digital usage would consider applying for a loan through digital channels. 26 to 50% of the respondents said yes. Again, just maybe a little bit on the conservative side. And for the final and fourth question, which asked which type of digital engagement will be the most effective or will be the best predictor of a micro enterprise's willingness to borrow via digital channels, a majority of the respondents chose online banking, with e-commerce a close second. So thanks to everyone for your participation in the survey. In the next set of slides, Ben will walk through our machine learning findings in relation to the poll answers that were just provided. Back over to you, Ben.
Thank you so much. On this slide, we're looking at the drivers of revenue decline. In other words, what's correlated with the deepest shocks to revenue for the reporting microenterprises. The colors on here, the orange and the yellow colors, are the indicators of the most severe levels of revenue decline at the height of the crisis. So that's down 50% or more in yellow and down 100% in orange. So the fractions that are listed there are the number of reporting companies who state that their revenues are down by this amount. The takeaway from this slide is that emergency funds are protecting businesses against revenue shocks, as are digital payments. So let's begin with the emergency funds that I referred to earlier, one of the key determinants of financial health for microenterprise customers. In the right column, we can see that those companies with emergency funds have smaller revenue shocks. That is, the yellow and the orange bars are smaller than the column on the left. In both the top row and the bottom row, the rates at which customers report severe or complete revenue declines is smaller when microenterprises have emergency funds on hand to help them through a crisis. And on the other comparison here, we're comparing the top row, the companies that use digital payments or that accept digital payments from their customers, versus those that don't in the bottom row. And so again, we can see that they're in the correlations as reported to us by our respondents to the survey. There's a clear difference between companies that use digital payments and those that don't, and those that have emergency funds and those that don't. So a word of caution, this is not a controlled social science experiment, yet it does tell us something about the level of correlation that we observe in the world as it occurs today. The companies that have emergency funds and the companies that are taking digital payments are clearly suffering smaller economic shocks than the rest, and each works conditional on the other. You can do the comparison left to right in the top row. You can do the comparison left to right in the bottom row. You can do the comparison top to bottom on the left side and the comparison top to bottom on the right side, and it works in both directions. Next slide, please. Another question about the determinants of the depth of the economic crisis here. Here we've omitted most of the levels for clarity. So we're only looking at companies, the fraction of companies that have reported revenues down 25% or more, 50% or more, and 100% or more. But the colors are the same as on the preceding slide. Yellow for down by half or more, and 100% is orange. Small businesses, SMEs with larger emergency funding pools, suffer less severe revenue declines. So what this means is if we look over on the right side of the graph and ask about the pile of cash, the emergency fund that will get the company through the crisis, if it's greater than 8 weeks, we see across the board smaller levels of economic shock. These companies are better positioned just based on the financial health going into the crisis, which was correlated with lower revenue shocks overall. However, in the blue bracket in the middle, or the teal bracket in the middle, when this criterion is not met, meaning there's less than 8 weeks worth of expenses that are held in cash, we find that increasing loan sizes are actually positively correlated with the shocks facing companies. So if there are at least 8 weeks worth of expenses held in cash, the trend goes away or even reverses. However, when there's poor financial preparedness for a crisis, the size of the loan outstanding in absolute dollar terms is positively correlated with the rate at which SMEs report these larger economic declines, shocks to turnover or revenue that are 25% or 50% or even 100%. Next slide, please. Forecast revenue recovery for microenterprises rises with digital payments. Across the x-axis, we've spread out the companies by the value of their loan in quintiles. So equal-sized groups, there are exactly the same number of respondents in each of these 5 sets of companies. And we've further subdivided those groups by whether or not the respondents take digital payments. Then we've asked them to tell us in percentage terms relative to pre-crisis levels, what's the forecast revenue recovery at 90 days? I think it's pretty self-evident from this graph that within some populations, but not others, in other words, for the smaller loan sizes, companies that are accepting digital payments are seeing that the future is brighter. They're telling us that their revenue recoveries are going to be stronger than those that don't accept digital payments. Yet things are not equal everywhere. So we'll find that this trend holds, particularly at the smaller loan values and not as much at the larger loan values. Next slide, please. Microenterprises with lower revenue recovery forecasts have more short-term investment assets. These are the things that we mentioned before: gold, livestock, and real estate. We find that an income recovery predicts prudential asset holding. Short-term investments are held in order to raise cash during a crisis, and they can be liquidated if things fall apart. Microenterprise clients with higher short-term investment assets seem to face a greater loss of revenue and expect slower recovery to pre-crisis levels. One hypothesis for why this is maybe a preference for microenterprises to put funds toward productive uses instead of holding assets on the sidelines where they're not being put to productive use. Next slide, please. For small businesses, SMEs, the greater the expected recovery, the larger their need for working capital. So here we're looking at the tools that will be used by small businesses to rebuild following the crisis. The small businesses in orange on this slide selected working capital as the main constraints on their businesses today. The 3 firms' customer bases are divided by whether their 90-day revenue forecast is above the median, 30% of pre-crisis levels, or below. So we're able to see within each firm's customer base, on the left side, there's a below 30% group, and the right side is an above 30% group. Those are the forecast revenue recoveries at 90 days. Working capital is the most pervasive need, as expected, but firms with higher forecast revenue recovery have a larger need for working capital, and they're less likely to tell us that it's the thing that they need least. Next slide, please. Lower revenue recovery expectations for microenterprises predict higher demand for term loans. We offered microenterprises a choice of financial products and asked them to say which would be their top 3 most needed products to help them on the recovery. Some of those were related to insurance and savings, and several of them were related to credit. Respondents were asked to rank order their top 3 needs among working capital, emergency loans, capital loans, revolving credit, term loans, and other services. And here what we're looking at is these very strong trends within some, but not all, the portfolio companies. Poor revenue forecasts predict term loan demand. If we look from left to right at 5 equal-sized groups, 5 quintiles of forecast revenue recovery, and then count up the rate at which the firms in that group told us that term loan demand would be their most helpful, or second most helpful, or third most helpful, we can see this clear negative correlation. The more, the lower is the predicted revenue forecast at 6 months, the greater is the demand for term loans relative to other financial progress. Okay, I'll try and slow down. I'm mindful of the timing on the webinar, so I will, I'll try to stop rushing, and thanks for that. Again, with machine learning, one of the things that we find is that the correlations that we're able to unpack can be situational. They can be very true in one market and not in another. They can be very true of one portfolio company and not of another. And so we've done our best to really highlight the places and the ways in which these correlations crop up so that they're easiest to see and understand. If we fit this with a simple linear regression model across the entire portfolio, we might not see exactly the same types of results. And that's why we use the algorithms to unpack the data in the survey. Next slide, please. A large proportion of unplugged microenterprises are likely to consider a digital loan. That all by itself is just an interesting finding. Users that today don't use digital technology to run their businesses, that today don't use social media to reach out to their followers and customers, they're not building a digital brand, they're still open to the idea that their first toe in the water for digital might be a lending product for their businesses. I think in many ways it's not surprising that businesses that are already digital would be interested in a digital loan as a way of obtaining a loan because they're doing many other things digitally already. But this idea that 40% of microenterprises with effectively no digital footprint today are still open to the idea of a digital loan is sincerely interesting. Users here are grouped based on whether they currently have any use for digital technology and whether they use social media channels to reach customers today. So for each of these firms, we've got the left and the right group are based on whether they do or don't use digital technology today for business. And then the 2 colors of the bars are based on whether they have online contact with customers, meaning social media, Facebook, WhatsApp, and Twitter. Or in China, there are different social media networks that are used. So we accounted for that in the way that we phrased the survey questions. And we still see for the dark green bars that there are large numbers of microenterprises who would consider a digital loan, even though today they're not using digital to advance their businesses. Next slide, please. Finally, we'd like to understand what are the main drivers of willingness to borrow digitally. So here we've broken out the functions of digital tech in the business today. And these are overlapping categories. So you can imagine that there might be a company that shows up as a yes in bill pay that's also yes in e-commerce, or that's also yes in payments, or that's also yes in social media. The only one of these that's exclusive is the yellow bar for none, or the yellow lollipop for none. That's the only one that doesn't overlap with the other categories. So here we've looked within category and said what percentage of the firms that today accomplish this function digitally would also be open to a digital loan. And this allows us to unpack which technologies are best correlated with an appetite for digital lending. And it looks to us like across the board, across all firms, bill pay is the number one. But again, situationally, there are markets where payments is a better predictor than bill payment for openness to borrow digitally. And it's intuitive that these things would be so because they are financial technologies. It makes sense that those companies would be the ones who would be first to go digital with lending. The dots reveal the percent of users within each category that would consider taking the next loan digitally. And not surprisingly, the lowest average is for the group that has no digital today. But in some markets, the rate is at or above 50% for willingness to borrow digitally, even if they're not using digital for these technologies today. And I think that should conclude my portion. Is that true? Yes, thank you very, very much for the opportunity to speak about this today. And I'd like to turn it over to Suma for the next portion of the webinar.
Thank you, Ben, for those great insights. Hi, everyone. Thank you for joining us. Good morning, good evening, wherever in the world you're joining us from. I'm Suma Swaminathan, a vice president on the private equity team here at DWM, and I cover the Asia portfolio. As a quick note, please continue to post any questions that you have in the Q&A box on the Zoom interface, and we will leave some time at the end to address it, and we'll address it along as we go. Today, I'm very pleased to be joined by Nikesh Kumar Sinha, the CEO of Ashwa Finance. For this next segment, what we thought we would do is switch the lens from looking at so far what we've been doing based on BFA's analysis, looking at the aggregate portfolio data. What we want to do now is just switch the lens and look at how one of our portfolio companies is using this data. Because ultimately that was the key objective for us, was to support our portfolio companies in identifying what the economic impact of the shock is, when to start relending, how to start relending, and also the question that's on top of everyone's mind, has this actually accelerated digital adoption? And if so, how do we go about doing that? So it's my pleasure now to introduce Nikesh. Nikesh has been the CEO of Intelligro now. In erstwhile Intelligro, what is now Ash, he's been the CEO for 2 years, brings over 2 decades of experience in SME, lending and banking, having worked earlier at Axis Bank, one of the top largest private sector banks in India, where he was heading the medium enterprise group. So Nikesh, thanks very much for joining us today.
Thank you, Suma.
Turning to the conversation, I just want to flash up on screen a dashboard that the Ashwa management team and the teams have created to compare how Ashwa data on each of these different metrics is comparing with the broader pool of SME data that came in through the survey results. And so this is just to give you a sense of how the analysis that's being presented is being used at the portfolio company level. And I will be referencing some of the insights that came up during the machine learning process, some of the earlier slides that came through. And so as Nikesh and I go through the conversation, we'll walk through, and sometimes there will be a slide coming up just so you have a clear sense of which data point we're referring to. There was a question in the chat box from UG, a great question on whether our hypotheses on these data insights can be provided. The hypotheses, which is one of the most critical elements of it, as we went through the process, we realized it's specific to the local context. And so we've been discussing with the portfolio companies directly on where some of these, the underlying rationale for it and the reasoning for it, what might lie there. And hopefully during this conversation with Nikesh, we can address some of those points and bring out, at least from the perspective of one portfolio company, how they're thinking about it. So without much further ado, let's begin the conversation. Nikesh, thanks again very much for joining us today. It's a pleasure to have you on.
My pleasure too, Suma. Thanks to the whole DWM team.
Thank you. So we'll get started, and we've segmented it similar to how we've discussed the themes. The first one is on the economic impact. So just to set the context, in India, of course, we know crises, as in most of our emerging markets, crises or shocks occur every 2 to 3 years. Most recently, we've seen demonetization, we've seen GST, and we know from the Ashwa portfolio that the NPA levels, when at their peak, similar to the rest of the market, may have hit 8%, 8.5%. The question to set the context is, how is this different, and what are you seeing right now in Ashwa's portfolio in response to the COVID-19 crisis?
Suma, I think what a demonetization did was it separated companies with good governance and misgovernance, right? And the impact of demonetization or GST, for that matter, was very localized, a country specific, and it affected the country. And there also anybody had good governance went over it. The biggest difference with this now is the pandemic. This is a global issue. Even small-time exporters have been hit. Supply chains were hit. And as you're aware of, that India had one of the severest lockdowns in the world. For 5 to 6 months, things were practically shut all across the country, except for essentials. So this is a completely different scenario. People who survived the demonetization, people who had good governance could easily overcome it. But good governance is not a response that will take you through this crisis, as it very rightly comes out of this survey. In fact, one thing I want to point out, what this is brought out is this survey has brought out and the pandemic has brought out is this is highly unpredictable today, and such surveys and the insights they provide, they actually arm you with a set of information which is so important to take a mindful or an informed decision in such times of uncertainty.
Thanks, Nikesh. That's actually a good segue to the next question and on the next slide, because it ties in directly with a point Ben made earlier as part of BFA Global's machine learning analysis, which talks about ultimately for the SME clients, there were two key takeaways from it. One is that having emergency funds of more than 2 months seemed to indicate less severe revenue dips. The second one is loan size. It seems to be that those with smaller loan sizes have less severe declines or vice versa. So both these seem to be indicators, at least from the machine learning analysis. So the question to you, and this addresses the hypothesis point, is what are you seeing at the Ashwa portfolio? Any thoughts on why this might be the case or how it's playing into your strategy?
Actually, this completely corroborates with our empirical evidence that we've been seeing. And so, in fact, you are aware of Ashwa and our history. We used to do larger ticket loan, and it was at the board level that we decided and we came up with a strategy that A, we should be a significant lender to a borrower. B, we should look at small ticket loans, because that is where we create an impact. That's the space where we should be. And in that direction, we launched what is known as the cluster product. Very small companies with 70 lakhs, which will be 100,000 turnover in an annual turnover, and we would give them, say, a 7 lakh loan or $100,000 that is a $10,000 loan. And we've seen 95% collection in that segment, which is actually, I'm seeing no stress there in that segment. So we are not seeing stress there. In fact, even today, the highest level of stress or collection, the lowest collection efficiency is visible in the larger ticket loan. And coming back to the earlier, savings and ticket size. So if somebody had 2 months of saving, somebody could build up 2 months of savings. It is also a proxy that the business was generating a surplus to keep aside. The business had enough margin. That coupled with smaller ticket size tells you about the resilience, and that actually tells the significance of going in for small ticket loans, but at the same time being a cash flow lender, which I will tell you later on at some other slides. I will tell you what we have been doing. So that really helps. So if you're a cash flow lender, this really works very well. And this hypothesis is completely tested with our data. Our smaller ticket loans, we are seeing 95 to 87% collection efficiency. We have less than, I heard somebody quote, in some portfolio companies, you're seeing 20% restructuring requests and all that. We've not seen even 2%, at least till as of yesterday. How it pans out, if there is a second wave, is a different thing. We've not seen more than 2% in a small ticket loan category, not more than 2% of restructuring requests also. So I completely actually second what's the outcome of this data.
Yeah, that's very interesting. And of course, for those of us who've been associated with Ashwa and erstwhile Intelligro in that form, we know that it's been part of the strategic initiative to reduce the ticket sizes. And even now, I know that ticket sizes have gone down by, or are right now limited by close to 50% of what it was, primarily, I think, reflecting on the ground what we are seeing in the data here. So I think that brings me to the next part of it, which is more in terms of how you're thinking about new products. On the next slide, one of the machine learning insights that we looked at earlier was on working capital for SMEs. By far and away, the most important need which has come out, intuitive, if you think about it. And in Ashwa's data set, it looked like, I think, over 80% of the respondents said working capital is the most critical need. How is that figuring into the implementation on the ground of where you begin relending, what sorts of products you start relending with?
So we've been a working capital lender. We are not we don't lend for creation of assets, right? And the segment, the micro segment that you look at, if you look at any micro segment, probably this will be secular across the globe, the fixed costs are very low. probably somebody just setting up a shop in the corner of a road, or just very little. So the demand for asset creation is very low until there's a machinery involved. So it's inevitably the working capital demand. And we've seen this demand come back. We gingerly stepped back into the lending space sometime in the month of June as India was partially opening up. And what we've seen, the progress has been that our accounts, our volumes have now exceeded that of January. Also because we've opened, our branch network has expanded marginally more. And also because the demand is there, but it's coming from that segment itself. So the demand for working capital is very much there. And to add to it, Suma, when we do an analysis of our lending that we've done post the COVID thing, we've realized that the most of the CIBIL scores, 90% of the CIBIL score, which is the Indian rating agencies, I don't know what is the US equivalent for that. So there, 90% of our customers have a CIBIL score greater than 700. So it's so much so better because what's happened is people who can bounce back, and since we are a cash flow lender, and that's what I told you in the previous slide. So we do a machine check of all bank statement and we see how intact the cash flow is. And that's how we see the how good or bad the customer is to lend. So that's really helped us. And I'm again seconding this hypothesis. The Ashwa experience is this: the demand for working capital is back. Even if you look at the Indian economy and you look at the fast-moving economic indicators, the petrol consumption is 90% of pre-COVID level. The GST collection, that's the goods and service taxes revenue collections, have again hit the 1 lakh crore mark, which is a high. So these fast-moving indicators, e-way bills are back to a January level. That's the amount of goods getting transported. So like I mentioned, there was a supply chain disruption. That's actually got restored. So it's very natural with goods moving and payments happening. And I'll again reiterate something that was mentioned before in the earlier presentation. India has also been helped in this recovery by the fact that the digital payment is very pronounced in India. It's probably one of the most advanced countries in the world when it comes to digital payments, transmission of payments. So yes, so I think all that, we climbed the capability around that, and the demand for working capital is completely back, I feel.
Yeah, and I think the other part that we'll touch on, I think I want to leave some time for the question after the next one, which is on the digital. And so it'll be great to get your thoughts on that and how you're seeing it within the Indian context and the Ashwa context. Before we do that, I wanted to get your thoughts on the next slide, actually, where we spoke about the gender imbalance, and also what we're seeing, which was a fairly exciting finding when you were looking at it about how the rates of e-commerce adoption are much higher among women. And so we know that SMEs intuitively, and even in the data earlier, it's been seen that SMEs are more likely to be male-owned. It's unsurprising, doesn't make it any less urgent of a need to fill. And we see that, in the data set that we are working with, about 24% are female-owned SMEs. I know that in IntelliGrow's case, it's about 29, close to 30%. These are conversations I've also had with the CFO of Ashwa, Kiran. She and I have discussed this. So I know it's a conversation happening at the board level and the senior management level. But I want to give you a couple of seconds just to address that in terms of how is Ashwa as an SME lender thinking through this gender imbalance that exists in SME financing? And are there any initiatives where we know that there's 1 or 2 products underway, but just wanted to get your thoughts on expanding on what those initiatives are?
Thanks, Suma. As you rightly mentioned, we've already launched a product. We call it the Mansa loan. That's exclusively for women, SME entrepreneurs who are women. And what we see and what our field forces across the distribution tell us, there is substantive demand there. And it's not just the e-commerce bit. Even otherwise, it's just that people have not stepped out and seen or recognized. For example, when you're talking of a micro loan, it could be a tea stall also. It could be a roadside shop also. In fact, we brought out this loan up to 3 lakh. And there are lots of women doing it in India. A loan up to 3 lakh. The demand is there. Somebody has to reach out, create a product for them, and deliver it to them. One has to reach out. And I think this is, we are very confident that we are going to break this. As it is, we have 29 to 30% women in our portfolio as entrepreneurs. With this product launch, we are hopeful that the count will go up substantially, but there is a market for sure there.
Yeah, that's good to hear. And I think to begin with the lower ticket size, and then the question it is something that I think overall as an industry that one is grappling with on how do we get more women from the SME segment to narrow that gap in financing. But the next question, which I think is on top of everyone's mind in terms of the digital adoption, we've seen, so on the next slide, actually the next two slides, maybe, if you don't mind, Ashwin, it may be the last one. So here on Ashwa's data, it's if you take a look at it, 86% say they're comfortable applying for the loan digitally. Even though I know the levels of digital adoption in India, we've been working closely with it, that number, with all of that considered, is still extremely high. And that's a positive. We've also seen that even those who are currently unplugged, at least 40% of them are willing to go on to being digitally plugged in. A lot of this begins institutionally. A lot of it begins with having the institutional capability to allow your clients to adopt digital. So the question is, can you just give us some background on Ashwa's digital transformation? Those of us who are associated with Ashwa know that it's in the midst of this transformation journey. So a little bit of context there, and what is needed to get this 86% to be fully digital, at least in their engagement with Ashwa.
Yeah, so thanks, Suma, for this question. You're aware, but for the audience at large, Ashwa is a combination of Tribe3, which was a fintech, and we were a NBFC, which was a lending company. We had the balance sheet. The two entities merged sometime in the month of March, and that was very timely, actually, because that gave us the digital capability to tide over the pandemic. For example, thanks to that, we could actually we invoked DCP in our company even before the government of India announced a lockdown, and we had the confidence to do that because we had an LOS, a loan origination platform that was completely digital. Then at some stage, we introduced a video PD. That's a video physical, discussion. So it was not a physical discussion, it was a video discussion happening with the client who were giving us loans, say sometime in the month of June when we restarted it, because you could not afford or risk that. So that gave us the capability to do that. Now we've reached a stage that once the loan is sanctioned in the platform itself, the document for the agreement for signing with the client is generated from the platform itself. So that's the extent we've come over. And not to talk about it, we also have a data sciences team, which is working because now we have all the nodes of the process getting captured. And so that helps us. Like to work on the TAT. And we've actually crashed our turnaround times of post-COVID when we started distributing by about 50%. We came down from 18 days to 7 days. Once a document is, we are ready to give a sanction in 2 days, actually. So that's thanks to the digital. And this is not all. We have to go beyond our inward-looking capability. We've also developed a mobile app, which has been cleared and this has been built in-house by the engineering team that has come through the merger with TribeTech, which is actually now been cleared by the Google App Store for the policy. It meets all the Google Store policy requirements. And we should be in a position to launch the app sometime in this quarter. And with that, our customers can actually not only apply for the loan digitally through this app, through their phones, they can just upload their bank statement or the PAN card that flows into my system, and the whole thing happens digitally. And by the way, all the repayments, any which ways, are happening digitally in Ashwa, either through checks or digitally. And we are also in the process of migrating most of our customers from checks to digital repayments through Nash. So if you look at it right from onboarding a client and to the repayment by the client, by the end of this quarter, we should be completely digital. Not only that, since we have a model and a data set behind us, our data sciences team and the credit and risk is working together to come up with algorithmic decisioning. So this is the whole set. This is the whole thing we are building up, which we are fairly confident we should be in a position to launch by this. And this is so much needed in this pandemic, actually, to reach out. And thanks to this survey, we actually pushed the pedal on this project also, because this, what was just an intuition is now an informed decision that yes, there is a big market and my own client set is looking for this.
Right. Yeah, I think that's a very compelling story, Nikesh, and it's a very compelling arc that we've seen, and actually explains also the shift from IntelliGrow to USH for this entire branding change. Underlying that is this digital transformation.
Correct.
And you're right, that 86% number, more than anything else, it's backing for the fact that there is this willingness to adopt digital at broad scale among the client base. We've seen it across the portfolio as well. But Thank you very much for your insights. We do have a few questions that have been coming in within the chat and the Q&A section. And so I'll take a couple of minutes to address it. I recognize we're running a couple of minutes over, but maybe we can take 2 questions. Anything that we haven't addressed, we'll get back to you on after the webinar. So the first question, I'll direct this. There's a question for Ben and a question for Nikesh. I'll start with the question for Ben, which came in from Fatima Ademo. Hi, Fatima. The question from you for Ben is, Ben, have you noticed any differences in the impact on SMEs across regions? And has the request for new financing among SMEs, has it primarily been working capital related, or was it primarily for CapEx?
That's a really incredible pair of questions. Across the board, the manifestation of the crisis. Oh, start my video. Sorry about that. Yeah. Across the board, the manifestation of the crisis has looked rather different in different markets. And so the things that companies are telling us about everything is actually rather different. How deep is the shock to revenues today? What are the things that they most need to turn things around? What types of products would be most valuable to them? But I think this number is really a number that gets at the depth of the differences. In some markets, we've had over 85% of small businesses tell us that the thing that they need most is working capital, and less than 1% of them will respond that the shortage of qualified workers is on their radar at all. And yet in other markets, we are seeing only 58%, 59% of respondents focused on working capital, and a larger number who are telling us that a shortage of qualified workers is impacting their business today. Nearly 20%, 1 in 6 respondents. So vast differences in the manifestation of the crisis and what it means for not only getting through the crisis today, but rebuilding those businesses in the period of 6 months from now. The other thing that I'd like to sort of toss out as a number that really helps illustrate the differences in the way that the respondents to the survey, that's not the portfolio companies, but their customers are navigating the crisis, looks like this. If we look at the revenue forecasts among respondents to the survey and say, where do you think your revenue will be from here out 90 days? The ones with the lowest revenue are focused on different types of credit products from the ones who look out to the future and see the strongest revenue projections. So those, and maybe this isn't surprising because I'm not a financier, but for me, this is a really telling number. If we look at the weakest revenue forecasts, over 80% are focused on term loans or revolving credit. Whereas in the highest revenue recovery expectations, we see that those customers are most interested in working capital and crucially on asset purchases. They want lending to be able to buy the next asset that will help them get to their perceived revenue recovery levels. So really different types of lending products that would be valuable to the respondents in the survey. If we look across the portfolio and just ask them, what do they see when they look in the future? How strong are their prospects for recovery from here out 3 months? And recall that the survey was in the field in August of this year, so 90 days out. We're just getting to that period of time now when those recovery expectations can be ground truth. They can be checked against the track records of the companies from here to the middle of November. Thank you.
Yeah, and it's a good point to bring up now, because one of the things we're trying to do at DWM is engage in additional waves, because the situation is changing. As we know, there's still a lot of uncertainty. So the idea for us is always that this data is real time, that it's actionable, and that for that we'll be engaging in a wave 2 of this survey. And I'll provide a little more information in a couple of minutes. But on this, we'll just move on to the next question. Maybe we'll take one additional question that just came in through the Q&A, and this maybe is for both of you. But Ben, maybe it's on, is there a difference in probability of default from past research between women-led and male-led businesses? And I guess one would be from a data standpoint, and Nikesh, if you're seeing anything within the portfolio itself. Ben, can I hand it over to you first, or Nikesh, either one of you?
I'm not sure that I actually have data points in this on the default rates of customers. I think it is an idea that we certainly explored, and I would love to have the opportunity to work in closer detail with the portfolio companies to generate a view of their data that they'd be willing to share with us. And actually, the recent advances in encryption have made it possible for us to do those types of calculations without violating confidentiality and privacy agreements. So there is the window for us to do this without radical changes to financial privacy law that maybe wasn't there just a couple of years ago. Nonetheless, I have to be a little bit circumspect in what I can state about default rates on client portfolios, and I'm sorry about that.
No, maybe a research project for Wave 2 then.
I'd like that very much.
Nikesh, any thoughts on that?
No thoughts on that. In fact, given the kind of the age of a portfolio and this, we have very little data to back us up for me to give you a very solid answer here. Given our data set, and especially the small ticket for us is less than 1 year old. So we don't really have too much of a PD history there.
Yeah, and I think what we've been seeing mainly, at least on the SME side, is the lower vintage of having this data to be able to do the analysis. I think on the micro side, there is a lot more evidence available and a lot more research that has been done, which I think people are fairly aware of. The other question, just one question, and then we can end it, which came in through the Q&A. And so this is for either of you, whoever has the answer. Nikesh, we'll begin with you. Given the learnings presented today, what have you identified as the most pressing need for lenders? And what kind of support could a DFI or a donor provide? You know, for instance, is it more liquidity? Is it more risk sharing? Or is it providing technical assistance, for instance, to enable digital loans? A great question that has come in, and one that I think will be very relevant to the audience. And Nikesh, if you have any thoughts on that, would be great to hear it.
So definitely liquidity, especially for MSME lenders, because if you look at it where they are in the ecosystem curve, MSME lenders per se in the Indian context, they've not really matured, say like the way microfinance has. Banks have been doing MSME lending, but digital and fintech players, they're just beginning up to be there. So I think given this market, liquidity should be a very important concern for them. So I would rate liquidity 1. Despite the fact that it was mentioned earlier that most of the organizations have been carrying 18 to 20% of cash right now, though there is a negative carry to carrying that. But still, I think liquidity is number 1. 2, because after all lending institutions are leveraged lending institutions. So I think liquidity is 1. Technology is 2. Risk sharing can be the 3rd, because I somehow feel risk sharing can be a form of a subsidy. Finally, every organization needs to get the risk right. So this is how I will actually place them in order. Liquidity, learnings of technology. If you can bring learnings from other mature markets where this has been a success model, then technology, because both first 2 are about capacity. 3rd is about survival, risk sharing.
Yeah. Thanks very much, Nikesh. Ben, if you have any thoughts on that, if not, we can move on to the conclusion. All right, thank you. So thank you, everyone. I know we went over a little bit, but we did want to give enough chance for all of the questions, and I'm glad we were able to have such an engaged discussion. If there's any questions that we've left out, we will respond separately. And if there are any questions that you have for us, we have the contact detail up, privateequity@dwmarkets.com. I want to thank everyone that helped us, the participants for joining in, the BFA team for their immense effort with this entire project, and the portfolio companies for working through this entire initiative and talking through the analyses with us. And of course, our investors, without whose support the foundation of this initiative wouldn't exist. I mentioned the Wave 2 earlier. If any of you on the call are interested in partnering with us or collaborating with us on Wave 2, please feel free to reach out. We want this to be an industry-wide exercise, one that as many FIs or as many institutions that can gain support from will. Just another housekeeping note, we'll have a feedback survey that's coming up when we log off from the call, and we'll also follow up via email. So if you can please give us your feedback, that would be greatly appreciated. But without taking up any more of your time, on that note, I'd like to end the webinar. Thank you very much from the DWM side, the PE team, and all of DWM for joining us today. We're glad you could participate and hope to see you soon. Thanks all. Bye.
Thank you.